The cost of plant assets includes all expenditures necessary to acquire the asset and make it ready for its intended use. This video will explain the accounting for plant assets, such as buildings and equipment. Once cost is established, a company uses that amount as the basis of accounting for the plant asset over its useful life. Plant assets are resources that have a physical substance, are used in the operations of a business, and are not intended to sell to our customers. These assets are expected to provide service to the company for a number of years. Except for land, plant assets decline in service potential or their ability to produce revenue over their useful lives. They are called a variety of names, such as property, plant, and equipment, or fixed assets. Plant assets are critical to a company's success. For many companies, investments in plant assets are substantial, as indicated in this slide. If we were in the classroom, I would show you this image and ask you to identify the plant assets. Remember, plant assets have a physical substance, they are being used in the business, and expected to provide service for a number of years. So I hope you identified the parking lot, the Wendy's sign, the fence, the outdoor seating, the building, and the land are all plant assets. If we enter the building, the counter, the cash registers, cooking equipment, and furniture are all plant assets. Without these assets, Wendy's would not be able to provide a service and satisfy their customers. The historical cost principle requires that companies record plant assets at cost. Costs consist of all expenditures necessary to acquire an asset and make it ready for its intended use. It does not include financing charges. Of course, there's an exception to this rule, and it will not include any cash discounts. For example, if a company purchases equipment with credit terms of 210 net 30 and they take advantage of the discount, they would reduce their cost by $70. So the cost of the equipment is not $3,500, but rather $3,430. Companies use land as a building site for a manufacturing plant or office building. The cost of land includes all necessary costs incurred in making the land ready for its intended use. Costs typically include the cash purchase price, closing costs such as title and attorney's fees, real estate broker commissions, and accrued property taxes and other liens on the land assumed by the purchaser. These costs increase the land account. Let's assume that this company acquires real estate for $100,000. The property contains an old warehouse that is removed at a net cost of $6,000. They also pay $1,000 for attorney fees and $8,000 in real estate commissions. Based on these numbers, what is the cost of the land? Before you answer that question, remember you must include all the cost incurred in making the land ready for its intended use. If the land has a building on it that must be removed to make the site suitable for construction of a new building, the company includes all demolition and removal costs, less any proceeds in the land account. The cost of the land is $115,000. This includes the cost of the property, the net removal of the warehouse, attorney's fees, as well as the commissions. When this company records the acquisition, it debits land and credits cash for $115,000. Land improvements are structural additions with limited lives that are made to land, such as driveways, parking lots, fences, landscaping, and underground sprinklers. The cost of land improvements includes all expenditures necessary to make the improvements ready for their intended use. For example, The cost of a parking lot includes the amount paid for paving, fencing, and lighting. The company would debit the total of all these costs to land improvements. Unlike land improvements have limited useful lives. As a result, the company will expense or depreciate the cost of land improvements over their useful lives. We will discuss this concept in the next video. Buildings used in operations are stores, offices, factories, and warehouses. Companies charge to the building account all necessary expenditures relating to the purchase or construction of a building. When a building is purchased, the costs include the purchase price, closing cost, and real estate commissions. In addition, you must also include costs incurred to make the building ready for its intended use. For example, you would include the cost to remodel offices and repair the roof. When a new building is constructed, its costs consist of the contract price plus payments made for architect fees, building permits, and excavation costs. In addition, companies add interest cost or financing cost to the cost of a building, but only during the construction period. When construction has been completed, any interest payments on funds borrowed to finance the construction are recorded as increases or debits to interest expense. Equipment includes assets used in operations such as store checkout counters, office furniture, factory machinery, and delivery trucks. The cost of equipment includes all costs incurred in acquiring the equipment and preparing it for its use. The cost of equipment consists of the cash purchase price, sales tax, freight charges, insurance during transit if it's paid by the purchaser, and it'll also include expenditures that are required in assembling, installing, and/or testing the equipment. Companies treat annual recurring expenditures that do not benefit future periods as an expense. For example, the cost of a motor vehicle license and insurance on company trucks and cars would be an example of a recurring expenditure. Let's assume that this company purchases a delivery truck for $22,000. It also pays for sales tax, painting and lettering, a motor vehicle license, as well as a 3-year insurance policy. The cost of the delivery truck is $23,820, and that consists of the cash purchase price, the sales tax, and the painting and lettering. The cost of the license is an expense, and the cost of a 3-year insurance policy is a prepaid asset. The journal entry to record this transaction results in a debit to equipment for $23,820. You're also going to debit license expense for $80 and debit prepaid insurance for $1,600, and the credit to cash is for $25,500. Let's assume this company purchases a machine for $50,000 and incurs the following costs: sales taxes, insurance during shipping, installation, as well as testing cost. The cost of the factory machinery is $54,500. This includes all the cost incurred in acquiring the equipment and getting it ready for its intended use. The journal entry for this transaction would result in a debit to equipment for $54,500 and a credit to cash for the same amount. During the life of a plant asset, a company may incur cost for ordinary repairs, additions, and improvements. Ordinary repairs are expenditures to maintain the operating efficiency and expected life of the asset. They usually are fairly small amounts that occur frequently throughout the life of the asset. Ordinary repairs are debited to maintenance and repairs expense as incurred. Examples are motor tune-ups and oil changes, as well as replacing worn-out gears on factory machinery. Additions and improvements are costs incurred to increase the operating efficiency, productive capacity, or expected life of the asset. These expenditures are usually material or large in amount and occur infrequently. These expenditures increase the plant asset affected and are often referred to as capital expenditures. Number 1 and 2 refer to land. Please keep in mind this company purchased land with the intention of demolishing the building, as noted in number 9. Don't forget to include number 10. And lastly, the solutions to this problem will be provided in another document.